Welcome to this interactive study guide on stakeholders. In business, no one operates in isolation. Every decision a business makes affects someone, and in turn, many groups can influence the business. Understanding these relationships is key to scoring high marks in your GCSE Business exams. In this video, we'll break down internal and external stakeholders, their objectives, and the inevitable conflicts that arise between them. Let's dive in. Let's map out the key stakeholder groups. Internal stakeholders are part of the business itself, owners who invest capital and seek profits, and employees who work for wages and job security. External stakeholders are outside but still have a stake. Customers want value, suppliers want prompt payment, the local community wants minimal disruption, and the government wants tax revenue and compliance. Conflicts arise when these objectives clash, for example, when owners push for cost-cutting that reduces employee wages or product quality. Turning to our core study notes, it's crucial to distinguish between a stakeholder and a shareholder. A stakeholder is anyone affected by or who can affect the business, while a shareholder specifically owns shares in a limited company. Dividends are the financial reward shareholders receive from profits. Remember, all shareholders are stakeholders, but not all stakeholders are shareholders. This distinction often appears in exam questions. Stakeholders influence business in various ways. Owners exercise power through voting at annual general meetings and can replace directors. Employees affect productivity and can take industrial action like strikes if dissatisfied. Customers provide revenue and can boycott or leave negative reviews, damaging reputation. Suppliers can raise prices or withhold supplies. Understanding these levers helps you analyze how businesses must balance competing interests. Let's work through a typical 6-mark question. The business cuts costs to boost profits. Shareholders welcome this as it may increase dividends. However, employees may face redundancies or pay cuts, leading to lower motivation and possible strikes. To score full marks, you must explain both sides and evaluate the trade-off. The best answers consider long-term consequences. Unhappy employees can reduce quality and customer satisfaction, ultimately hurting shareholders too. Watch out for common mistakes. First, never use stakeholder and shareholder interchangeably. Second, when discussing conflict, always explain the reason behind it, don't just state they disagree. Third, in evaluation questions, consider the context. For a small local business, the community might be more important than for a multinational. Always justify your reasoning. To wrap up, remember that stakeholders are central to business decision-making. Internal stakeholders include owners and employees, external include customers, suppliers, community, and government. Conflicts are inevitable, and examiners love to test your ability to analyze these tensions. Use the stakeholder map to structure your answers, and always evaluate which group takes priority in a given scenario. Good luck with your revision.